Hi, welcome. It's been only a couple of days since the US presidential election. No, don't worry, I'm not going to tell you who I voted for and why, not because I don't have views on politics, but I save those for my friends and family. My focus has always been on markets and companies, and I'm going to keep that focus. But there will be a political twist. In this election cycle, we saw something that I've never seen before, at least in the form that it took. We saw political markets open up where you could actually go in and buy shares in who you thought would win the election. And it was visible. You could see it in ads, you could see it in the candidates themselves talking about it. I want to use this post to talk about those political markets, what they did well and badly, but put in a larger context of what do markets do well, what do markets do badly. And in fact, this has been an issue as long as markets have been around. Are markets wise? The wisdom of markets, the wisdom of crowds. Are markets crazy? The madness of crowds. So let's step back and think about elections. A couple of days before election day, my wife and I went to the movies. We don't go that often, but the movie we went and watched was a movie called Conclave. It's based on a book by one of my favorite authors, Robert Harris. And it's fiction, but it's fiction based on something that does happen and has happened for centuries in the Catholic Church. In the Catholic Church, when the Pope dies, the cardinals get together in the Sistine Chapel and they pick a new Pope. It's an election. And during the movie, you could see the cardinals jockeying for position, gauging support for one candidate or another, doing informal polling. And I'm sure that if you went back to the earliest democracies, in Greece or Rome or wherever else, that informal polling has always been part of the process where people are gauged on who they'll vote for, that nobody's completely surprised when the actual vote happens. Formal polling has been around a while. In fact, the first recorded history of polling that I was able to find, at least in the US, was for the 1824 presidential election, when a newspaper polled 504 people to decide who would win the election. And they concluded that Andrew Jackson would beat John Quincy Adams. And they were correct. Starting in 1916, the Literary Digest in the US had a survey. It wasn't exactly statistically kosher the way they did it, but they asked their readers, so there's a sampling bias, only the people who read the digest were voting, who would win the election. They were correct for the next four elections, but they failed miserably in 1936 because they predicted that Alf Landon would beat FDR, and he actually ended up winning only 2 out of 50 states, so they were horribly wrong. The reason, of course, being sampling bias. Now, this is something you're going to see return over and over to my polling discussion, is sampling bias. So after the Literary Digest fiasco, polling tried to become more scientific. George Gallup, whose name is still attached to one of the most famous polling firms in the US, put together a group that tried to figure out how to make polls more scientific. And for a while, it looked like it worked. And in 1948, this more scientific polling delivered one of the biggest misses of all time, where they predicted that Thomas Dewey, governor of New York at that time, would beat Harry Truman to become the president of the US. In fact, newspapers were so convinced by these polls, they actually printed the headline to be Dewey beats Truman. And one of the most famous photographs of all time, you see Harry Truman holding up that newspaper after he'd won the election. That was 1948. The decades after, polling became better. Polling became more accurate. Now, as you get to the end of the 20th century, pollsters thought that they'd conquered the polling problem. When you say conquered the polling problem, they'd at least conquered the bias part of the problem. They'd figured out a way to get samples that reflected the population that would vote. But even when you remove sampling bias from polls, there's sampling error. What does that mean? When a pollster says that candidate A is going to get 52% and candidate B is going to get 48%, you are getting that conclusion from a sample, and because it's from a sample, your estimates could be wrong. It's called a standard error. And that standard error could be 2, 3, 4%, which means you could be off by 2 or 3 or 4%. So individual polls, even if they have no bias, can have error. Can you fix it? Well, in the last 4 or 5 cycles, there's been one attempt to fix it, which is to average across multiple polls. What does that do? It brings in the law of large numbers. So if you have 50 polls and the average across 50 polls is that candidate A will get 52% and candidate B will get 48%, that average should be much more precise than any individual poll. Good idea, right? And in fact, leading into the 2024 election, you had multiple aggregators. Here's one. It's called RCP. It basically takes multiple polls, and you can see that, and it's over a particular period, over a 2-week period. And they take the average leading into November 5th of 2024. Their prediction, based on the average, was the election would be a tie, based on at least the popular vote. Now you're saying aggregators reduce noise. Do they also reduce bias? Not necessarily, because the way they pick the pollsters to include in their sample, remember, it's not all pollsters, there's a subset, could reflect bias. And some of the aggregators use weights based on past accuracy of individual pollsters to come up with weighted averages. So individual polls have sampling bias and sampling error. Aggregators should have less sampling error but could still have bias. There's a third try that people started to make, again, maybe 3 or 4 cycles ago, where you had poll experts take the aggregated polls and then bring in what they knew about voters, qualitative factors, past history, to make a prediction. I'll focus on a couple of the best known ones leading into this election. One was Nate Silver. Nate Silver made his reputation as a statistics geek at the New York Times. He, in fact, created the original 538. And he became famous because he did a really good job on the 2012 election in predicting Obama's win. And Nate Silver has since left 538 in the New York Times, and he now has his own site forecasting elections. And he bases it on aggregated polling, but then he brings in a twist of judgment. So leading into this election, and this is now no longer a percentage vote, this is a probability of winning, he predicted that based on what he saw in the polls, there was about a 50-50 chance of Trump or Harris winning. 538 still remains as a site. It's now owned by ABC, and they made their own predictions based on simulations. In other words, they fed in the data on voters and polls, and they ran simulations, and 52 times out of 100, Trump won, and 48 times out of 100, Harris won. So polls, sampling bias and sampling error. Poll aggregators, less sampling error, but potentially still bias. And now we have these poll judgments, which may reflect more information, more expert work, but still may reflect bias. Let's face it, people have lost trust in polls, poll aggregators, and poll forecasters because in 2016 and 2020, they did a pretty bad job. So there's a vacuum that's being created, and into that vacuum step political markets. What are political markets? Rather than trust a poll or a poll aggregate or a poll expert, you let markets tell you what investors in that market think about who will win. Again, these are not percentage votes. These are likelihood of winning. The first to show up was a market called Polymarket. It's been around for much of this year. They've been allowing you to take bets on who will win the election. So the red line here is the people who think Trump will win. The blue line is the percentage, the people who think Harris will win. And based on this market leading into the election, investors in this market thought there was a 60% chance that Trump would win and a 40% chance that Harris would win. Notice that those numbers reflect a higher, this market thinks there's a higher chance Trump would win than you saw in the Silver or the 538 forecast, the poll judgment calls. Now, as you look at this market, and I'll draw more attention, you'll notice that there's been a lot of volatility leading in, especially in the last few weeks. Now, part of the reason you should ignore the pre-July numbers here is pre-July, it wasn't Kamala Harris who was the candidate, it was Joe Biden. So it's only the post-July numbers that reflect the true Trump versus Harris volatility. For several months this year, Polymarket was the only game in town. But starting in July or August, you saw an alternative to Polymarket, a market called Kalshi. It's a market, again, where you make bets on Trump. It's very similar to Polymarket in terms of how it's structured. And in this market, Investors in this market thought there was a 58% chance that Trump would win and 42% chance that Harris would win, leading again into November 5th. Now, a couple of things about the structuring these markets. They're slightly differently structured. Poly market has no trading costs, but because it's set up with blockchain and crypto driving the market, there's a currency conversion cost because you pay in dollars. The trading cost overall is about 1 to 2%. Kalshi has its own trading costs, but essentially the trading costs are not backbreaking. They allow people to bet on outcomes. So with that lead in, let's talk about just poly market versus Kalshi and how the two markets have sometimes diverged over the last 2 or 3 months where they've both been around. They're ultimately doing the same thing, allowing you to bet on a Trump win. You're saying, why aren't they delivering the same numbers? Through this entire period, poly market has delivered a slightly higher chance of a Trump win than Kalshi, which suggests there's something structural in these markets, either in how they're set up or who they're attracting, that leads to this difference. So as you look at the bottom, you can see the difference is always in the direction of poly market. It's sometimes larger, sometimes smaller. And during the course of the last few months, in fact, I've had people emailing me saying, is there arbitrage here where I can buy the Trump win in the cheaper market and sell short on the Trump win in the more expensive market and claim the difference? I don't think so. The trading costs are there. There's structural reasons you might not be able to lock it in. But you can see both markets tend to move together. So, of course, we now know what happened on November 5th. And part of what I'm hearing from the markets is this is vindication. We had a higher chance of Trump winning and he won. But it's a sample size of one. And it's true the political markets did a better job, at least on this particular election, of gauging a Trump win. Having said that, though, let's talk about the two dimensions in which political markets deviated from either the polls, the poll aggregators, or the poll judges. On the plus side, political markets were incredibly dynamic. They reflected things in real time. I'll give you an example. So debate a couple of months ago between Trump and Harris, and right after the debate, poly market reduced the odds of a Trump win by about 10%. Polls eventually caught on, but it took them 2 or 3 weeks. So markets are more dynamic. On the minus side, political markets can be volatile for all the wrong reasons. What do I mean by the wrong reasons? The right reasons are fundamentals, things like the debate or an interview or something that happens that changes the dimensions of the race. But often prices can move for other reasons. There was a Wall Street Journal story about a whale, a big trader on poly market who would bet $30 million on a Trump win. Affected the odds, affected the prices. So markets are both more dynamic, more volatile, and that sets the stage for what I would like to make the bulk of this session about. It's about the wisdom of crowds versus the madness of crowds. What crowds do well versus crowds doing badly. Before I do that, though, let's start with a reality check. So much of what we do in our lives is driven by crowdsourcing. You remember I talked about that movie, Conclave, that we went and watched, my wife and I chose to watch over the weekend. Well, Conclave, the way we picked the movie was we didn't read up movie reviews or in the newspaper or on a movie site. We actually went to Rotten Tomatoes. I'm sure many of you used Rotten Tomatoes. Rotten Tomatoes takes movies and TV shows and gives you what critics and the audience have voted on. So you're essentially getting a crowd judgment on that movie. And great crowd judgments. Right after the movie, we went to a restaurant. You know how we picked a restaurant? We looked up Yelp reviews. Again, crowdsourcing our choice. The way we pick our plumbers or electricians are based upon often a crowdsourcing way. We live much of our lives driven by what crowds are doing. On a larger and less personal scale, you could argue that the blockchain that underlies Bitcoin and so much else that we see in crypto is essentially crowdsourcing something that we used to trust banks to do. Even on our news, we've taken to getting our news from social media, which is essentially crowdsourcing our news. And already you can see the basis for both the pluses and minuses of markets. One of the problems with just crowdsourcing is it doesn't cost me anything to go on Rotten Tomatoes and vote up a movie or vote down a movie. In other words, when the cost of entry is small, you can have people entering of no business being in the crowd, offering an opinion because there's no consequence to be out, to give an outlandish opinion. Here's what markets do that make them perhaps better than a typical crowd. They charge a price to enter the crowd. The price is the market price. People are willing to pay the price, are able to give their opinions, and people who want to amplify their opinions actually have to spend even more money. In Nassim Taleb's words, we're essentially restricting the crowd to those with skin in the game. That should improve the crowd judgment, right? And perhaps it does. Markets are crowds with restricted entry. What do crowds do well? Especially the market type crowd where there's a price, where there's an entry fee. Well, having studied financial markets, and financial markets have been around for centuries, here are the things that markets do that make them almost magical. The first is they aggregate information. What does that mean? You put 100 people in a market, you give them each a small piece of news about what they're trading on. They don't know what the other people's news is, but you let them trade. Markets aggregate the news, so what you get as the market price is reflective of what all 100 people knew. Somehow the magic of trading aggregates news in a good market. Second, and we talked about in the context of political markets react instantaneously to news. That gives them an advantage over experts who take months often to assess the news. You get an instantaneous response. It could be wrong, but you get in real time to things as they unfold. The third is, as markets get bigger and there's more trading, the law of large numbers might work in your favor. What does that mean? Individual traders can make mistakes, horrifically bad mistakes. Those mistakes can come from either bad assessments or just bad bets. But in a market, those mistakes can average out as long as they fall on both sides of the divide. So in well-functioning markets, this is what drives the success of markets. And there's some research that's coming out in recent years that shows you why market judgments, even when they're made by traders who might not be viewed as informed, can often be better than experts. Phil Tetlock wrote a book on super forecasting, where he contrasted what he called were foxes and hedgehogs. See, why are we talking about animals? Foxes are what he called people who know many things but not much in depth. Hedgehogs were people who know a lot about one area. Experts are hedgehogs, traders are foxes. And he found that the best forecasters actually knew a lot of different things. And in markets, you bring people with lots of different perspectives in. Experts, in his view, get in tunnel vision. They get so caught up in their subject matter that they can't step out. And over the last 4 years since COVID, I've been keeping track of expert forecasts versus market forecasts. And guess what? Every single time, the market has done a better job. So markets can be wise. So why don't we trust markets all the time? Because our history with financial markets also tells you that markets can make some mistakes, and some really horrifically bad mistakes. That while they're capable of aggregation and consensus judgments, those mistakes can come from quirks in markets. One of my favorite books is almost 200 years old, published in 1841, called Extraordinary Popular Delusions and the Madness of Crowds. You can find versions of it somewhere on the internet. And in that book, the author writes about markets that have blown up. And in 1841, the markets he looked at were the South Sea bubble, a market for a non-existent investment in the South Seas that got pushed up in the London markets, and tulip bulb craze, where tulip bulbs in Holland saw their price get pushed up in markets to levels that were unsustainable. His argument was crowds don't always do wise things. Now, of course, people say, well, that was in 1841. We've advanced and we're much more evolved. Not really, because many of the things you see him talking about in that book in 1841, you see replayed on steroids. In fact, the mistakes we made in 1841 become even bigger because of technology and big platforms. So why do markets sometimes break down? Here are the reasons. First, In finance, we often talk about noise versus information. You're saying, what's the difference? Information is things that should matter, that drive the value, the pricing of what you're trading. Noise is stuff that happens that cause you to deviate. Noise and information exist in all markets. And if there's balance, information offsets noise. It kind of counters noise. But in markets, when noise becomes the dominant force, prices can delink from information. The second contrast is between momentum and fundamentals. We know that in markets, momentum is a strong force. What prevents momentum from essentially overriding everything else is there are fundamentals that push back. Again, it's balance. What does that mean? If you push an asset up based on momentum to a level that's unsustainable, in a good market, there should be people who come in as short sellers and counter you. If you push the price down, there should be bargain hunters. Again, it's a question of balance. And if the balance is lost, momentum can override fundamentals. The third is a market attracts a subgroup of people. People are willing to pay the price. And if those people have lost connections with what they're trying to bet on, it could cause a problem. Take the example of political markets. To enter political markets, you need money and you need to be comfortable with that kind of technology. I'll wager that the typical trader in poly market and Kalshi tend to be younger, maybe 25, 30 years old, 35 years old, tend to be better off. Now they're trying to make bets on what a population of voters who might not have those same characteristics are going to do. That could create a bias. Markets can be manipulated, especially if they're smaller, less liquid. I talked about the whale, the $30 million trader moving price in Polymark, and can get worse, right? You can have rumors fed in to move prices. There is this possibility that market manipulation can cause prices to deviate from what they should be and people profit off it. And finally, there's a feedback loop. What does that mean? Sometimes market prices can affect what they're trying to price. In stock markets, if you push up the price of a stock too much, a company might be able to issue shares at a higher price and acquire other companies and make investments, actually make itself better off. In the political markets, this played out in a fairly weird way. I started seeing ads from the candidates or people pushing for the candidates using graphs from the political markets. Look, we're doing so well. We're at 67% on poly market. And that in turn could influence how people vote, which could be a reinforcing mechanism. Those are all things that can work against it. They all were issues we faced in the political markets. So here's the bottom line. Should you trust crowds or not trust crowds? Well, if it's a crowd where there's no entry fee, you should probably be more wary. If there is an entry fee, you still have to think about the pluses and minuses. We've talked about the pluses. Markets aggregate. Markets are dynamic. Markets average out mistakes. The minuses, markets can be manipulated. Markets can be driven by noise and momentum. Markets are feedback loops. Am I willing to make a categorical judgment that I always trust markets over judgment calls, maybe from experts? No. I do think that in lots of areas, especially areas where there is no absolute truth, where experts are making judgment just like you are, based on information pulling in different directions, markets can often beat experts. But if you're in a world of absolutes, you don't want to trust markets. You don't want to create a market of, is the earth flat or is it? No, we know it's not flat. Having a market tell you otherwise doesn't change that. There is a use for political markets that you might want to consider. I have a feeling that political markets are here to stay. I wouldn't be surprised if you saw weather markets. After all, who trusts the weather forecaster? They get so much wrong. Maybe we'd be better off having a weather forecasting market. But here's the use for political markets you might want to consider. Many of you are emotionally invested in who wins an election. They're emotionally invested because you want one side to another for all the right reasons. I'm not saying your reasons are bad. But let's say you're emotionally invested in one side winning, candidate A winning. Maybe the next time around, you should buy shares in candidate B winning. You think, why would I want to do that? That way, on election day, one of two things is going to happen. Either your candidate is going to win, you're going to feel emotionally happy, financially, you're willing to give up, right? So you're going to lose some money. Or your candidate is going to lose, you're going to feel emotionally drained, but your bank account might be much better and you might feel a little better tomorrow. I'm not saying it's going to be completely offsetting. I, for one, am glad there is now a political market in place, because I have a feeling that these political markets are going to be accessible in the rest of the world as well. Because, the way polling is going, I think that sampling bias issue we talked about has returned in spades, because people have cell phones, they can stop you from calling them. I don't think we're going to regain that trust in polling. So maybe these market-based judgments are not so bad to have, not just in politics, but in a bunch of other areas where we've trusted experts. I hope you found this session useful, and I thank you very much for listening.